Today, we're diving into an investment analysis on Open Door, which frames that recent 9% drop as a huge buying opportunity, citing a massive cash reserve and a pivot to real estate tokenization.
And the energy in this report is just undeniable. That headline, open stock crashed 9%, perfect time to buy the dip. It grabs you.
It really does.
But, if you're going to argue a huge price drop is totally disconnected from reality, you need absolute rock-solid proof.
Right, and that seems to be the first big theme here. The analysis is pretty aggressive in just dismissing that 9% price move.
Yeah.
It argues you should buy the fear because the business didn't change. No earnings miss, nothing like that. It's just a stop-loss hunt.
That's a solid foundation to start from. But it's still, an assertion. It's not an airtight argument yet.
So the first thing is the analysis would benefit from a more nuanced approach to justifying the fake nature of that crash.
Exactly. It needs to go beyond just calling it a stop-loss hunt.
Because the report sort of quickly dismisses the drop as behavioral or macro, like a market rotation out of tech.
And that's the weakness. It's great for the buy the fear energy, but it creates a logical vulnerability. It doesn't rigorously establish why that rotation didn't actually impact the company's core value.
If we're calling it a discount, not a disaster, we need to make that a mathematical fact, not just a claim.
Yes, the claim that the business didn't change needs some external validation to really land.
So the suggestion here is to integrate external contextual proof points.
Right, you have to solidify the claim that the drop was fundamentally disconnected from the company's actual outlook. Isolate the price movement from the fundamentals.
Okay, so let's brainstorm some concrete examples. If this is for a sophisticated investor, how do we really weaponize the data?
Well, instead of just saying no earnings miss, you need to show some comparative evidence.
Okay.
For instance, what about referencing sector performance from that specific day? How did other tech-heavy peers behave?
Ah, I see. If they all drop 9%, it supports the macro story.
Exactly. But if Open was uniquely targeted, the stop-loss hunt idea becomes way more compelling. Then you just have to show why those stops were there.
And this is where that $962 million cash fortress comes in, right? It's mentioned, but it's not really leveraged as a defense.
It is the ultimate defensive weapon, and it needs to be fired immediately. The most powerful concrete example is to just calculate the precise per-share value of that cash.
Do the math for them.
Do the math. If you take that, say, 962 million and divide it by roughly 650 million shares, you land somewhere around $1.48 per share in cash.
That's significant. A mathematical floor of nearly $1.50 against a $6 stock. It really reinforces that the actual business is only being valued at, $4.50?
Precisely. And the analysis should state that explicitly. Because $1.48 of every share is backed by cash, the 9% drop disproportionately impacts perceived risk. That turns an assertion into a powerful, calculated argument.
That definitely bolsters the defense. It proves why the market move was, illogical. But theses aren't built on defense alone. So if the crash was just a blip, what's the engine that drives this to that aggressive $8 target?
And that brings us right to the strategic pivot, which is, I think, the part of the analysis with the highest potential energy. To elevate this refounding thesis from just a nice kicker to a primary catalyst, the report needs to connect the dots better.
Connect the new leadership, the blockchain strategy, and a plausible timeline for revenue.
Yes, the report identifies Lucas Matheson and his exploration of blockchain and real estate tokenization as the key hidden catalyst.
Right. Using that very evocative analogy, the Coinbase of real estate.
It sounds amazing.
It does, but what does it actually mean operationally for a company that buys and sells physical houses?
And that's the core vulnerability here. The weakness is that the analysis just relies so heavily on that analogy without giving any specifics on how it becomes a real business model.
We're missing the operational detail. You can't weigh the risk versus reward, especially with an aggressive $8 target by January.
An $8 target based on a concept is a tough sell. If the pivot is the reason for the upside, you have to show the reader the first few steps on the roadmap.
Absolutely. So the suggestion is to provide foundational detail on this pivot. Define the milestones that need to be hit for Open Door 2.0 to actually take shape.
Let the investor assess the feasibility for themselves. Move it from just hype into actual strategy.
Okay, so concrete examples. What's the core problem this solves? Open Door's biggest issue is capital lockup, right?
Exactly. cash tied up in inventory.
So if blockchain is the answer, it has to address that directly.
Precisely. The analysis could define that. For instance, is the goal to fractionalize assets? If they can suddenly sell tokenized equity stakes in their homes to partners, that dramatically increases liquidity.
And turns inventory way faster.
That's a measurable financial impact. It operationalizes the idea. It turns a buzzword into a solution for a real balance sheet problem.
What about that $962 million in cash we were just talking about?
Well, that's not just defense. It's the funding for the pivot. Another example is to offer a scenario. How might that cash be deployed? Is it for R&D? Is it to acquire a blockchain firm?
It shows that the cash runway risk is being managed with a strategic spending plan.
Right. And finally, you need short-term signals. The market isn't going to wait around for the full thing to be built.
Good point.
So, what indicators should we look for in Q1 or Q2 earnings? The report could suggest monitoring for a new line item, like digital asset development, or an increase in R&D spend.
Or even better, a reduction in the days to liquidate inventory. That's the ultimate proof that the pivot is actually working.
Now you're tying the long-term vision to short-term, measurable progress. And that's how you justify an aggressive near-term price target.
Okay, so let's move on to the technicals. The analysis does a good job establishing that $6 floor and the psychological defense line around 580 to 6. Provides a really strong anchor for the buy the dip thesis.
The entry point is well justified. Technically, I agree. But the trade plan itself, it lacks the necessary rigor by sort of minimizing some key risks.
Okay.
So while the technical analysis establishes that $6 floor, the weakness is that the aggressive upside target, that potential 80% gain, and the plan to load the boat are presented without a proportional look at the downside.
It's that classic high conviction trade mentality. But for an expert, you have to address the obvious counterarguments.
Right. The analysis just dismisses bankruptcy as not on the table right now, solely based on the cash position.
Which is a firewall, sure, but it ignores the potential cash burn from running a dual strategy.
Exactly. You have to address the cost of maintaining the capital-intensive iBuying model and funding a huge, untested pivot into crypto technology. That transition risk shortens the runway.
So the core risk isn't just the market, it's the operational complexity of juggling two demanding business models at once.
That's it. So the suggestion for improvement is to introduce and constructively address those relevant downside risks. It shows the reader the analysis is robust and considers all probabilities.
Let's focus on technical risk management first. What happens if that $60 anchor just breaks?
Well, the analysis should explicitly outline that scenario. What happens if the 580 support fails? And what fundamental factor would trigger that?
Like an unexpected inventory write-down next quarter?
Or a major change in interest rates that just accelerates selling despite the oversold RSI. Outlining that contingency plan shows true rigor.
And finally, the short interest. It's high. The analysis correctly frames that as squeeze potential, but that's only looking at one side of it.
It's only half the story. That high short interest is a signal of deep skepticism from professional traders. They're betting on operational failure or dilution.
So you have to address that skepticism head-on.
Exactly. The most effective way is to frame it as a challenge. Don't just list it as positive squeeze fuel. The analysis should then immediately explain why that skepticism is misplaced.
Maybe by detailing how the cash reserve buys them, say, 3 more quarters of runway than the shorts are even accounting for.
Now, you're strengthening the bull case through acknowledgement and a swift, data-driven refutation.
This analysis report has all the makings of a definitive piece on this open trade,